Last episode, we turned $10,000 into $51 million with NVIDIA. Sounds amazing, right? But here is what we didn't talk about. At one point, you'd be down 66%. Two-thirds of your money gone. Could you hold through that? Most people can't. They panic, sell at the bottom, and miss the recovery. Today, we're asking a simple question. Can AI help us fix that? Let's find out. I am Sean, and this is Prompt to Profit. Quick recap from Episode 1. We ran buy and hold backtests from 2011 to 2026. QQQ turned 10,000 into 1.2 million. Max drawdown, 35%. Tesla, 10,000 became 24 million, but the max drawdown was 73%. And NVIDIA, the star of the show, 10,000 to 51 million, but even NVIDIA had a 66% drawdown. Big returns, bigger pain along the way. So the question is, can we keep most of those returns while cutting the drawdowns? Before we ask AI for help, let's look at these charts ourselves. Here is NVIDIA with the 200-day moving average. When NVIDIA drops below that blue line, pain follows. The 2022 bear market, price was below SMA 200 the entire time. So here's a thought. What if we only hold when price is above SMA 200? Go to cash when it drops below. Same pattern with Tesla. Every major drawdown lines up with price being under that moving average. Below the line, that is when portfolios get destroyed. This observation gives us a clear rule to test. We spotted the pattern ourselves. Now let's hand it to AI and see if the data backs it up. Now, I could spend hours coding this myself. Or I could ask Claude to do it in 30 seconds. I gave Claude the code from Episode 1 and said, I want to use SMA 200 to gate the entry and exit to reduce the drawdown. That is it. Just a clear idea in plain English. Claude gets it immediately and starts writing the code. It adds the SMA 200 indicator and sets a warm-up period of 200 days so the indicator has enough data. The entry rule, only buy when price is above SMA 200. The exit rule, sell when price drops below SMA 200. Claude even warns us about the trade-off. We might get some whipsaws and we might give up some returns in strong bull markets, but the improved risk-adjusted returns should be worth it. Let's see if that is true. Let's run it on NVIDIA first. Here are the results for NVIDIA with SMA 200 gating. Look at the equity curve. See those flat sections? Those are periods when we were in cash, gated out because price was below the SMA 200. Look at 2022, especially. The original buy and hold got crushed during that bear market. But our gated strategy? Sitting in cash? No pain. We still captured the massive run up to 32 million, but avoided some of the worst drops. The drawdown chart is much smoother than buy and hold. Now, the numbers. Drawdown is 57.7%. Still high, but buy and hold was 66%. We improved by almost 10 percentage points. Sharpe ratio is 1.129. Solid. We ended with 32 million instead of 51 million from buy and hold. But for many people, sleeping better at night is worth it. Let's see if this works on Tesla. Tesla, same SMA 200 gating strategy. Final equity is 1.3 million. That is significantly less than the 24 million from buy and hold. And here is the problem. Max drawdown is 71%. Barely better than buy and hold 73%. We gave up over 90% of our returns and only improved drawdown by 2 percentage points. Terrible trade-off. So what went wrong? Let's look at the trade history. In 2022, Tesla kept crossing above SMA 200 around $300, triggering a buy. Then days later, it drops back below and we sell at a loss. This happened 4 times in just 2 months. Each round trip costs us $40,000 to $90,000. Same thing in late 2023. 5 trades in 3 months, all losses. Buy, hold for a few days, sell lower. Over and over. That is the whipsaw problem. The strategy works when a stock trends cleanly, but Tesla doesn't trend cleanly. Tesla is much more volatile than NVIDIA. It whipsaws constantly, crossing above and below the SMA 200, triggering buy and sell signals that end up losing money. The gating strategy couldn't help with Tesla's slow grinding declines around the moving average. This is a crucial lesson. What works for one ticker may completely fail on another. NVIDIA has cleaner trends. Tesla bounces around like crazy. So what about something less volatile? Let's try QQQ, the NASDAQ 100 ETF. QQQ is diversified across 100 companies. Should be easier to manage, right? Here are the results with SMA 200 gating. Final equity 589,000. About a 490% return, roughly 6x. Our starting capital. Look at the equity curve. Much smoother than the individual stocks. You can see the flat periods where we sat in cash while the market dropped. The strategy avoided the 2022 bear market almost entirely. That is exactly what we wanted. But remember, QQQ buy and hold turned 10,000 into 1.2 million. So we gave up significant upside for that smoother ride. SMA gating works differently depending on what you trade. Great for NVIDIA, terrible for Tesla, and somewhere in between for QQQ. We need to try something else. So I went back to Claude. I said, the SMA 200 gating can improve drawdown. However, it is slow to respond. What other options do I have? Claude delivered several alternatives. Shorter SMA period like 50 or 100 for faster response, but more whipsaws. EMA instead of SMA, which gives more weight to recent prices so it reacts faster. Dual EMA crossover. AT our trailing stop that adapts to volatility. And percentage trailing stop, a simple exit when price drops a certain percent from its high. I decided to try combining EMA 200 with a percentage trailing stop. Trailing stop should let us ride winners while cutting losers quickly. I asked Claude to implement EMA 200 plus a 15% trailing stop. Here is the code. EMA 200 instead of SMA. Faster response to price changes. We define the trailing stop percentage, 15% from the highest price since we bought. When we're invested, we continuously update the highest price and calculate a stop level 15% below it. If price drops below that stop, we sell immediately. Buy when above the moving average, sell when we hit the trailing stop or when price drops below EMA 200. I ran this with different trailing stop percentages, 15, 20, and 25% on both NVIDIA and Tesla. Here is the full comparison table. Let's start with NVIDIA. The 15% stop actually has worse drawdown than 20%. Counterintuitive, right? Tighter stops get triggered more often. You sell, price recovers. You buy back higher, then it drops again. Whipsaw compounds into bigger drawdowns. The order count tells the story. 15% stop. 67 orders with only 45% win rate. 25% stop. 23 orders with 64% wins. And the 25% stop actually beats buy and hold on Sharpe ratio. 1.116 versus 1.092. That is our winner. Now, Tesla. Complete disaster. Every trailing stop configuration made things worse. Returns collapsed from 24x down to 2 to 4x. A 15% stop generated 141 orders and destroyed returns. Same strategy, opposite results. NVIDIA trends cleanly, Tesla doesn't. So where does QQQ land? Same pattern as NVIDIA, looser stops, better results. The 25% stop had only 5 trades over 15 years, all winners. Sounds incredible, but 5 trades isn't enough data to trust. Could just be luck. The edge over buy and hold isn't dramatic for QQQ. It is a diversified index, so the drawdowns are already more manageable. So what did we learn? Drawdown protection is not a free lunch. Every method has trade-offs. Tight stops destroy returns on volatile stocks. Loose stops work better but still can't save everything. The strategy has to match the asset. What works for NVIDIA fails on Tesla and barely matters for QQQ. And here's the real takeaway: AI makes iteration fast. We spotted patterns on the charts. We came up with ideas. AI wrote the code and ran the numbers. That is the workflow. You bring the ideas, AI brings the implementation. Neither works as well alone. There is no magic solution, no silver bullet. But with AI, you can explore the options quickly and make informed decisions. Next time on Prompt to Profit, we're going deeper. We'll explore more drawdown mitigation techniques from Claude's suggestions and see what else AI can come up with. That is it for Episode 2. If you found this useful, hit that like button, subscribe, and share. Drop a comment below. What is your approach to managing drawdowns? Any strategies you want me to test? You can find the code on GitHub, link in the description. Follow me on X for updates between episodes. I am Sean with AI Quant Studio. See you in the next one.